Thank you very much, Spider. A pleasant good day to my fellow St. Lucians, both those residing here and in the diaspora. This morning I will accompany my colleague, Stephen Fevrier, to lend my voice to this issue on the GPH deal. My remarks come after a revelation made in the House of Parliament with regards to the lease arrangement, which was for an amount of $1 annually for 30 years. I, however, will not delve into this matter, but will go a bit more and look at a comparative analysis between other GPH concession agreements in the Caribbean, and to get a sense as to whether St. Lucia received a deal, or whether GPH received a deal or a steal, as Spider indicated. So firstly, I will look at the Bahamas concession agreement. And St. Lucia, I'd like you to know that in the case of Bahamas, it is a joint venture between Nassau Cruise Port, who owns 49%, with GPH owning 49%, and Bahamas Investment Fund owning the other 49%, and the Yes Foundation, which is a foundation in Bahamas, owning 2%. So what we see is that Nassau Cruise Port is not owned entirely by GPH, but is owned by the government and people of Bahamas. The agreement in Bahamas is a 25-year agreement, lease agreement, and is for one port, Prince George Wharf, which was signed in 2019. The investment commitment is US $250 million, which includes building of terminals, expanding the berths capacity, and expanding retail and food beverage zones, and expanding entertainment spaces. Very interesting, though, is the social inclusion measures that the government of Bahamas has insisted upon. To ensure that ordinary Bahamians can directly benefit from this project, the Bahamian Investment Fund allows locals to invest a minimum of $1,000 equity into the project and US $50,000 in bonds. I want you to hear this. Ordinary Bahamians were given an opportunity to benefit in this particular project. And like I would have said earlier, the Yes Foundation, which is a foundation that has a specific mandate to fund and finance youth, sports, and educational initiatives in Bahamas, was allowed 2% share value in this company. I now turn to Antigua. In the case of Antigua, it's a 30-year exclusion concession signed in January 2019 between GPH Antigua and the government of Antigua and Barbuda. In this case, GPH has 100% ownership of GPH Antigua and operates a cruise port in Antigua. The investment commitment is that GPH Antigua will take on the debt of Antigua, the Port Authority of Antigua, which is at US $21 million, and will be making an investment of $30 million US to ensure that mega cruise pier capabilities and Oasis class vessels can both in Antigua. Crucially, though, the revenue sharing and fee arrangement is different in that GPH pays a variable fee based on passenger volume to the government quarterly. And the setting of tariffs is not limited to only the discretion of GPH, but the government has set clauses in there so they cannot increase the tariffs beyond the consumer price index or beyond 5% and must be approved by the government of Antigua. I now turn to St. Lucia, a 30-year concession agreement with a 10-year extension option granting GPH rights to operate. The investment commitment, as we know it, GPH is committed to invest in US, from my understanding, 60 million. This may be, which is subject to correction. This includes retiring of the existing debt of SLASPA and funding capital expenditure to expand the existing port infrastructure. Information reaching me indicates that the capital expenditure component is going to take 24 months and is going to be financed with funding from our local banking institutions. The financial arrangement, from my understanding, is a 15-year loan that has been secured from a syndicated loan, and the funding and GPH, which indicates that GPH now, after paying this loan, would have 15 to 25 years to cash in on the investment in St. Lucia. So I also want to take you and give you some feedback or some insight into a little about GPH. GPH, the Global Port Holding St. Lucia, is a wholly owned subsidiary of GPH Global Port Holding Limited, registered in the United Kingdom. Global Port Holdings, however, is owned by Global Port Holdings BV, registered in the Netherlands, which is also a subsidiary of Global Investment Holdings, a company registered in Turkey. This company, Global Investment Holdings, has a diversified investment portfolio including energy, finance, real estate, and infrastructure. And GPH is its international port subsidiary, focused on cruise and commercial port operations, and is the global vehicle used for port concessions, port acquisition, and port operations. It would be interesting to note that GPH was once listed on the London Stock Exchange at a market value of £191 million. On August 9th, 2024, a year to the date of signing the St. Lucia Agreement, GPH was delisted off the London Stock Exchange. Research has indicated that GPH had liquidity issues and funding constraints and was unable to raise equity financing on the international market, which explains why GPH is now finding resources in our domestic economy, our domestic financial institutions to raise or for this particular initiative. As a result of this delisting, GPH has consolidated its position substantially and now exercise totally strategic and operational control over concession agreements in the Caribbean. So what are the risks associated with this? The strategic decision made on our ports or for our ports is entirely in the hands of a Turkish company and is not driven by domestic or regional stakeholders. This, my brothers and sisters, substantially reduces the ability to shape or drive port policy in line with St. Lucia's national development plans and our global competitiveness aspirations. By being delisted from the London Stock Exchange, GPH is no longer obligated to disclose its financial statements, reducing financial transparency and due diligence. the long-term strategic lock-in. With a 30-year concession and a possible extension of 10 years, St. Lucia's port governance is effectively tied to a single foreign control structure for a generation. You must understand this. My niece, who is 3 years now, will be 33 years old when, or 43 years if the government decides to extend it by the further 10 years, when we can get out of this deal. This substantially limits the St. Lucia's government from renegotiating terms should the corporate strategy and ownership structure of GPH change. This should be called, in my humble opinion, Global Port Chokehold St. Lucia Limited. This cannot be a government that puts its people first. Wake up, St. Lucia. So I have a few questions I would like to ask the government. Clearly, the government had access to the Bahamian and Antiguan agreements. And the question is, why did the government not choose to go down that route? Why is it that we cannot access documents on the current arrangement? This flies in the face of transparency and accountability. The question is, why do we need GPH? All of the extension works that have been done in Port Castries has been managed by SLASPA, who has been in operation since 1983. I also want to know, did SLASPA have challenges in servicing its current debt? I think not. And I believe that SLASPA could have serviced its current debt and pursue capital investments on the ports without having to resort to going to GPH. SLASPA, for me, if we look at other countries, and my colleague would have raised the point that it reduces our competitiveness. In the case of St. Kitts, the head tax is at 6 US, Belize 7 US, Antigua 4.5 US, Grenada 4.5 US, Antigua 7.5, and now St. Lucia at 12 US. A question I would like to ask, why wasn't SLASPA made a stakeholder in GPH St. Lucia? As I would have indicated, in the Bahamas case, Bahamians were able to invest in the project. The question is, why the government did not allow SLASPA to become a shareholder? The government could have used the Bahamian model and allow citizens, credit unions, the library credit union, the teachers credit union, and local persons to invest in this particular initiative. GPH did not bring $1 of foreign direct investment to St. Lucia. In effect, it has gone to our local financial institutions and is now crowding out credit that should have gone to the private sector. Importantly, information reaching us has indicated that the technocrats in the Ministry of Finance advised the government against this deal, but the government went ahead nonetheless. So it is the government and the ministers in the cabinet who negotiated this deal. The question is, who is the ultimate beneficiary of this? We know that it is the cabinet of ministers who have tied us into this deal. So my brothers and sisters, I ask you, we have presented to you clear facts about the GPH deal, and we will be elucidating more on this as time goes by. But what is clear, that this government did not put you first. It did not put our future generations first. Thank you very much. Over to you, Spider.